Are adjustable rate mortgages bad? Are they risky? Are they going to cause you financial ruin? I'm going to talk about that today. As interest rates have been rising, the adjustable rate mortgage arm has gained in popularity. I just saw a stat where it might make up 9% of the mortgages being originated right now. So stay tuned. I'm going to give you the good, the bad, the ugly, the pros, the cons from my point of view when it comes to adjustable rate mortgages. All right, Matt, the mortgage guy here, mortgage broker, and the bringer of truth to you. I'm going to bring you what I see, hear, and feel from consumers, from other mortgage professionals, from the real estate market, whether you like it or not. I'm going to bring you up-to-date factual information straight here from the lab at the Matt, the mortgage guy headquarters. So anyhow, adjustable rate mortgage is something that's come up more often in 2022 as interest rates have climbed up. In 2020 and 21, when the 30-year fixed was sub 3%, there just wasn't any value in an adjustable rate mortgage. There wasn't enough benefit, between a 2.75 and if you can get an arm for 2.5, right? A quarter point difference in rate wasn't enough for somebody to take on the added risk of an adjustable rate mortgage. And first and foremost, let me explain to folks who don't know what an adjustable rate mortgage is. An adjustable rate mortgage is a mortgage that's going to adjust either every 6 months or every year after a fixed period. And that's something that folks don't understand. If you hear 5-year ARM, 7-year ARM, 10-year ARM, that 5, 7, and 10-year is how long it's fixed. So it doesn't adjust from the day it's written, right? It's got a fixed period where you might have a 3.875 for the first 5 years, the first 7 years, or the first 10 years. After that, it's going to adjust based on whatever index it's tied to. It might be prime plus 3 or whatever index it is. That doesn't necessarily matter. What matters is you'll see something like a 10-6 ARM. 10 years it's fixed. Then every 6 months, it's going to adjust. And then you can read the fine print on what index it's tied to and whatnot. What you want to do is you want to have a game plan and know that you're able to get out of that. What some people got into during the financial crisis, probably why ARMs have such a bad name, is they had a loan that adjusted after only 2 or 3 years. And they had no game plan for getting out, right? If lending guidelines were getting stricter and they couldn't refinance and the rate was adjusting up, bad combination, right? What I'm advising people today, whether they get a 5-year, a 7-year, or a 10-year, put a little thought into your financial picture 5, 7, and 10 years from now. Are you self-employed? Are you W-2'd? Do you plan to be employed and showing income in those years? Because you're going to most likely want to and have to qualify to refinance out of that to get into a fixed rate product that's a little bit more stable, right? Because what happens is you get a great rate at 3.875, but after 5 years, it might adjust up 0.5%, 0.5%, 0.5% on these 6-month increments. That thing could get up to, they usually have a ceiling built in, right? Where it can't go above the starting rate plus 5%. But still, going from 3.875 to 8.875, if you're borrowing $1 million, it's a lot of money, right? So if you want to talk pros and cons, the biggest con, and I think most people would agree with this, is that it is adjustable. And so your payment can move. Your payment can get more expensive. The pro is that plenty of products out there that are 7 and 10-year fixed. And let me be honest with you, I talk to people all the time. I know how long people stay in mortgages because we do refinances. We help people who are selling and then buying forward and moving. Vast majority of people aren't staying in the same home for 10 years, let alone the same mortgage. So if you're buying something in A, you either know you're going to be selling, moving, refinancing, something's going to change in the under 10 years, the 10-year ARM might make sense, right? Another huge pro, and I'll pull this up on the screen because I was literally doing this for a client today. $2.1 million purchase, 20% down. We've got two loan options, a 30-year fixed and a 10-6 ARM, meaning it's fixed for 10 years. The interest rate difference is a full percent between 4.75 and 3.75. We can get them an ARM for 3.75%. It's going to be fixed for 10 years. When you're borrowing $1.68 million, the payment difference is $1,000 a month. Almost exactly. It looks like it's $9 short, $991 difference in payment. So going to take the extra risk and know that in 10 years, this thing can and will adjust if you haven't refinanced out of it sooner. But for that first 10 years, $991 a month in savings. That's no small amount. And of course, if you borrow half that, it's going to be less. If you borrow a fourth of that, it's going to be less. But that's where, as a consumer, you've got to weigh the pros and the cons of an adjustable rate mortgage, an ARM, right? If I'm saving $1,000 a month, is it worthwhile? In this case, I think so. I think this is a financially savvy person who understands exactly what they're getting into, and they're not going to get in trouble. This isn't 2006. You're signing, an ARM that's going to adjust after 2 years. You got 3-year prepay and all that other madness that went along with that. So I think that it's something that, while scary for some to say, oh my gosh, if ARMs are now making up 9% of the market, what are people doing? Is it all going to crash? Somebody recently reached out to me too, and I totally get this because they said, hey, Matt, isn't this kind of a crazy time to get an adjustable rate mortgage as the Fed is raising the Fed funds rate? All these indexes that are tied to adjustable rate mortgages are going to be going up undoubtedly. True, they are. But truth be told, the 7-year ARM and the 10-year ARM are set to adjust in 2029 and 2032. Who knows where rates will be there then? Likely higher, but I think the best plans for people that are getting into these loans, they will not be in this loan for 5 years after. If you do a break-even analysis and you show if somebody took the higher interest rate of a 30-year fixed versus the ARM, and even if they stayed into it 3, 4, 5 years after the ARM period and it adjusted fully to the max, they would have paid less collectively on the ARM. Now, the counter argument to that is like, okay, but the payment shock. And if they're in worse financial position then and it adjusts up and you're at risk of losing your house, these are all real risks. I don't take those lightly. I want people to make sure that they understand exactly what it is, right? Because what you don't want to do is get into a mortgage that's going to adjust with no exit plan. I can't tell you, nobody can tell you what mortgage guidelines will look like in 5, 7, and 10 years. I can't tell you what your personal income statement's going to look like, what your credit score is going to look like, any of that stuff. Just know that that is something that needs to be taken into consideration. What is the exit plan? And so that's what I'm doing with a bunch of my clients when we're talking about adjustable rate mortgages, is we're talking about what is the exit plan, right? So hopefully this was helpful. If you have any questions at all, please feel free to reach out. These adjustable rate mortgages have some really fantastic rates. So it's something that a lot of folks should consider. On the jumbo side of things is where I'm seeing the most of these written. The spread isn't as drastic on conventional loans. So, it may be if you're buying a starter home for $400,000 with 20% down, this isn't something that would benefit you. But especially for jumbo loans, I'm seeing a huge spread. And when you're borrowing $1 million plus and you're talking about a 1% difference in interest rate, that's a lot of money. It's something to at least consider. Any questions at all, please feel free to reach out. greatmortgagebroker.com. Give me and my team a call. We're more than happy to help. Good advice all day, every day. That's all we do. Again, greatmortgagebroker.com. And thanks for watching. Until next time, we gonna see.